the amount of money that's likely to go into that ETF is going to dwarf all of the little traders trying to quote unquote front run that move. So I think the party's just getting started. I think the idea that suddenly people are saying, oh, we're back in a bull market. Well, again, we've been in a bull market for a year. And that chart that you showed, what's so great about it? It's a massive accumulation pattern. Now, there's two types of patterns in markets. There's accumulation and distribution. And accumulation patterns are a series of higher highs and higher lows. It doesn't mean straight up. Markets don't go straight up. They have volatility. They have ebbs and flows, and people get excited and people get afraid and greed and fear. But when overall there's general accumulation, you make higher highs and then you fall back, but you don't go all the way back to the previous low. You make a higher low, and then there's more accumulation. And the opposite happens in distribution. In distribution, you make a lower lows and lower highs. So it's like a ball bouncing down a set of stairs. That's a bad place. So look at Netflix chart, or even Amazon lately. There's a whole bunch of them that are definitely in a distribution pattern, and I think big tech is about to run into that proverbial wall on that. But Bitcoin is definitely in an accumulation pattern, and the whole idea of front running the ETF, on the margin. See how I did that? On the margin, yes, that is true, but overall, it's impossible, because what I mean by that is the reason it's not amazing, the reason it's so great is what the dark blue, the lower chart is human emotion. And what the top chart is the Bitcoin price, which is driven by human emotion. Bitcoin's still young as a market, right? It's not mature like equity. So equities, if you go back and you look at previous bubbles, the 1929 bubble or the 1840s bubble, or when markets were very young and they weren't sophisticated and computerized and the machines didn't run everything, you could overlay this chart. Like if you overlaid the 1929 crash on this chart, it would follow it perfectly, precisely, including the return to normal kind of bounce after the initial drop. And then there's the straight down and the depression, anxiety, denial, all the things, the 5 stages. And if you looked at the 2001, 2002 crash, same thing. 2007, 2008, same thing. But now the equity market isn't human anymore. It's machines. There are no humans. You go to the New York Stock Exchange, there are no humans, right? Bitcoin's run by humans. It is mostly individuals. There's a few machines out there trading on the margin. Bitcoin is so human as a market right now. It's why we have something called the Risk Managed Bitcoin Fund. And what it does, it's either in Bitcoin or it's in cash, depending on the trend, like an old-fashioned CTA, commodity trading advisor, and it crushes it. It lags in the up markets. It absolutely destroys it in the down markets, and over the long term, it wins meaningfully. And because that's just market timing. Like, yep, exactly. But in human-driven markets, turns out you can market time almost perfectly using simple trend-following analysis and a chart like this.
With a giant spotlight on Bitcoin ETFs, Yusko highlights this being a significant development in the financial ecosystem. He also suggests that BlackRock, under the guidance of Larry Fink, will lead the charge in obtaining regulatory approval for a Bitcoin ETF. This move, he contends, will underscore Bitcoin's enduring relevance as an asset and its potential as a hedge against currency devaluation. The ongoing adoption of Bitcoin by governments, institutions, and media signifies a broader recognition of its value. However, Yusko asserts this journey is just beginning. Comparing the initial years, to the current widespread interest and investment?
People don't pay attention to, I don't think, is the fair value follows this Metcalfe's law model. We've had Tim on the show and he talks about
Get Tim back on.
it has little fluctuations when things happen, like, China bans mining and the hash rate declines. Oh yeah, that's going to have an impact on the network. Guess what? And then it comes roaring back, and now we're at new all-time highs in hash rate. And you'll have people flee, and you get a bunch of wallets that disappear, but then they slowly come back, and now we have more wallets than ever before. And so the fundamentals follow this Metcalfe's law model. So, but the price isn't the value, right? We talk about this over and over in every asset. Price is a liar. Price is simply what you and I or two other people decide to exchange a small value of a good or service. That's the price. That's not the value. Right? The value of anything could be higher or lower. Right? That's when stocks are undervalued or overvalued, or bonds are undervalued or overvalued. Bubbles form. Right? There was a great. We do our weekly webinars, and we did the hedge with capital D yesterday, and Corey, one of my partners, had this great chart of the two big bubbles, the Japan bubble and the US stock bubble and the bond bubble. And they declined the same amount. It's like, well, that wasn't a bubble. Like, long bonds were in one of the greatest bubbles of all time because we took interest rates all the way to zero for 13 years. And everybody bought them. The banks bought them, everybody bought them, and the price got stupid, and the yields got stupid, and now that's changed, and TLT's down 50 some odd percent, fell the same amount as the Japanese stock market or the US stock market in 2007, 2008 global financial crisis. So bubbles pop. But the thing about Bitcoin is when it's below fair value, as it is today, it will drift. And what I say is fair value, again, according to Tim's model, about 50K, it's like 52, 53, but I'm not just rounded to 50. And we're going to drift toward that number because we're out of spring, we're in summer, June of next year. Then the halving occurs. Then we're going to go into fall. Now, what's fall? Well, fall is where people start to pay attention, because the halving happens, and now the fair value actually goes up, because now the price has to adjust to reflect the fact that the miners are getting less rewards. And he says, well, why does that have to happen? Like, well, it's just built into the code. And I think it's one of the mad genius things about the code is that you build in this mechanism that forces an increase in price, because rising prices attract attention. And so then you get the movement, and we'll get back to fair value. And think about fair value will now be 100. Okay, now we're going to drift back to fair value. Well, then what happens? It went from 34 to 100? Oh, I gotta get in, and you have the FOMO, and then you get the parabolic move, and then we get above fair value, which sows the seeds of demise that you have to have another crash. So this boom bust period.
Cycle of life, baby.
Cycles, and it's shorter than the norm. Like, stocks have done this for 200 years. It's an 11-year cycle, and we messed it up with the QE era. But if you go back and you look at history, there's this 11-year cycle of the economic cycle and the business cycle and the Fed liquidity cycle. It's not rocket science. It's not voodoo. It's real. And the cycle in Bitcoin is shorter because it was put into the code. And